Welcome back to GreenCandle. Last week, we broke down the glass highways with Corning. But let's be real. A highway is useless without a Ferrari to drive on it. Today we're talking about the engine, the company that turns electricity into light and, quite literally, keeps Nvidia from going silent. If you thought the fiber trade was hot, wait until you see the physics monopoly driving it. We aren't just looking at a stock chart today. We're looking at the heartbeat of the AI data center. Let's break down Lumentum. What you're seeing on screen isn't just a recovery. It's a violent repricing driven by physics. We are witnessing a structural shift where copper interconnects are finally hitting their thermal limit. They're getting too hot and too heavy to scale. Lumentum has emerged as the critical component monopoly for this transition. We aren't dealing with legacy telecom cables anymore. This is about the active engine that shoots the data across the room. The thesis here is simple. Lumentum has cornered the market on the 200G EML, the electro-absorption modulated laser. These are the physical light bulbs required for Nvidia's Blackwell clusters to talk to each other. The market has woken up to the fact that Lumentum has decoupled from its boring cyclical roots and is now a pure-play bet on the 1.6 terabit Ethernet cycle. This is the picks and shovels trade for the light speed era. This tiny chip represents one of the widest moats in the entire semiconductor space. To make a laser capable of flickering on and off 200 billion times a second without melting is an extreme engineering challenge. It's like trying to turn a lighthouse on and off at light speed. Only two companies on Earth, Lumentum and Coherent, can manufacture these indium phosphide chips at scale. It is a true duopoly with high barriers to entry. That allocated stamp you see is the most important data point today. Supply chain analysis indicates that Lumentum's 200G production is fully spoken for through mid-2026. This grants them immense pricing power. When you are the only game in town for the single most critical component in an AI cluster, you don't ask for a price, you set the price. The bottleneck isn't the GPU anymore, it's the laser that connects them. The numbers are finally catching up to the narrative. That rocket ship represents a 58% year-over-year revenue jump to $533 million, with an EPS of $1.10 that crushed consensus. But don't just look at the top line, look at the quality of that revenue. The growth is purely organic. This isn't financial engineering, it's raw volume demand from the AI sector. Here is the key takeaway. The cloud and networking segment grew 67%, completely overshadowing the legacy business. For years, Lumentum was priced like a boring industrial stock. Now, with this kind of acceleration, the market is forced to re-rate it as a high-growth AI infrastructure play. The turnaround is over, the takeoff has begun, and the fuel is 100% organic AI demand. For years, I stayed away from this stock because of the telecom drag, that heavy anchor on the right side of the scale. But the mix has fundamentally flipped. Cloud revenue now accounts for over 60% of the total pie and is growing north of 50% annually. The hyperscalers, Google, Meta, Microsoft, are so desperate for speed they are bypassing the traditional switch makers entirely. This direct-to-hyperscaler model is the game changer. They aren't waiting for Cisco or Arista to bundle these optics. They are knocking on Lumentum's door directly. While the legacy industrial segment is still a margin drag, it's becoming mathematically irrelevant. The investment case now relies entirely on the cloud segment's hypergrowth, which is more than strong enough to carry the dead weight. This is the strategic masterstroke that the market missed late last year, the LITE acquisition. Previously, Lumentum was just a component supplier. They sold the raw laser chip for pennies on the dollar to a middleman. It was a low-margin existence. With CloudLITE, they now manufacture the entire transceiver module you see on the bottom path. By vertically integrating, Lumentum now captures 2 to 3 times the revenue per unit. They went from selling the flower to selling the wedding cake. This allows them to secure direct design wins with the hyperscalers and bypass the traditional supply chain hierarchy. It's not just about selling more chips, it's about capturing the full economic value of every single optical link. While Google's use of Lumentum's optical circuit switch is nice, the real story is Nvidia. Lumentum has been selected as a key partner in the Nvidia Silicon Photonics ecosystem. Being designed into the reference architecture is the holy grail. It means that when a data center buys a Blackwell cluster, Lumentum is effectively pre-installed in the design specs. This serves as a massive volume multiplier. We aren't fighting for scraps or bidding on individual contracts anymore. We are part of the standard build. This partnership surpasses the revenue potential of any standalone switch contract because it ties Lumentum's volume directly to Nvidia's GPU volume. If Nvidia ships, Lumentum lights up. It's that simple. Let's get into the napkin math, because this is where the volume beast lives. The visual shows a simple equation. For every single 1.6T transceiver module, you need 8 separate 200G laser chips. This 1:8 ratio is the leverage point. A market shipment of just 5 million transceivers creates demand for 40 million laser chips. This is why the earnings are exploding faster than the module count itself. We have an exponential component multiplier on a linear product ramp. While the flagship OCS switches are high margin, they are niche. These 200G EMLs are the workhorses, the volume runners. This leverage is the primary force driving the recent earnings explosion, and we are only in the first inning of the 1.6T cycle. In this business, there are only 2 horses in the race. Coherent is the only formidable competitor with similar fabrication capabilities, but they are currently navigating a messy CEO transition and managing a complex, diversified portfolio. They're trying to do everything. While Lumentum is benefiting from a sharper, singular focus on the datacom vertical. And let's clear up a common misconception. Broadcom is not the enemy. Broadcom manufactures the DSP, the digital brain inside the transceiver. Lumentum manufactures the laser, the heart. They function as complementary partners in the ecosystem, not direct competitors. It's a symbiotic relationship. The real battle is Lumentum versus Coherent, and right now, Lumentum has the momentum. The bears love to talk about the in-house threat, the idea that Amazon or AWS will design their own proprietary silicon photonics to save money. And they might. But here is the physics mitigation. Silicon is an indirect bandgap material. In plain English, silicon cannot generate light. It physically can't do it. Even if the hyperscalers successfully design their own photonic chips, they must still procure an external laser source to power them. Who is the leading supplier of high-power continuous wave lasers? Lumentum. So whether they buy the full module or just the laser source for their homegrown solution, Lumentum gets paid. We win regardless of the architecture. Trading at 60x forward earnings sounds rich until you look at the growth rate. This premium is justified by Nvidia-like top-line expansion. If we model out the FY 2026 earnings at $5.50 and the full ramp of the 1.6T volume in FY 2027 hitting $8.20, the math starts to look very attractive. Applying a 45x multiple on that FY27 EPS of $8.20 implies a price target between 370 and 385. We are effectively paying up today for a monopoly that will be printing cash in 2 years. This isn't value investing. This is growth at a reasonable price, provided you believe the 1.6T cycle is real. The staircase on screen shows the path. We just have to walk it. Technically, we are in blue sky territory. The stock has broken out of all historical resistance and is in price discovery mode. The $300 level has established itself as massive psychological and structural support. As long as we hold that line, the trend is unmistakably parabolic. However, a word of caution, the RSI is hovering above 80. That indicates the stock is technically overbought in the short term. We don't chase vertical lines here. A consolidation or a healthy pullback to the $310 range would be a constructive development. It would let the moving averages catch up and give us a safer entry point for the next leg up. I'm not here to pump. I'm here to coach. The biggest risk is the bullwhip effect. If hyperscalers are currently double ordering 200G lasers just to secure supply, we could see an inventory correction next year once lead times normalize. We saw it happen in 2023, and it could happen again. Further out, we have the CPO, co-packaged optics, threat. If the industry transitions to soldering lasers directly onto the GPU faster than the projected 2027 timeline, the market for pluggable transceivers could erode rapidly. The mitigant is that Lumentum is also a leader in CPO laser R&D. But technological disruption is always a double-edged sword. Watch the timeline closely. Given the high implied volatility sitting near 85%, buying calls outright is expensive. The smart money move here is the income approach. I like selling the January 2026 put spreads at the $280 strike. You are effectively acting as the insurance company for the nervous bulls. Because premiums are so rich, selling the $280 put generates a yield equivalent to 10–15%. Here is the logic. If the stock stays above $280, you keep the full premium as income. If the stock corrects to $280, you get assigned the shares at a price point that represents an incredibly attractive long-term entry. It's a win-win setup for the patient trader. Lumentum has successfully transformed from a hardware commodity supplier into a high-octane AI infrastructure play. The market has finally woken up to the reality that without Lumentum's lasers, Nvidia's GPUs are effectively silenced. We are watching the active engine of the AI revolution at work. Disclaimer: I'm a guy on YouTube with a green logo, not a financial advisor. This content is for entertainment and educational purposes only. Do your own due diligence. My final recommendation: keep this on your radar. Look for dips into that $300 to $300 zone, and remember, we don't gamble. We make calculated bets. Class dismissed.